Just this last week, I purchased 3 more Dividend stocks. This is the 3rd week in a row where I've been buying aggressively, I've been dollar cost averaging, and I've been purchasing more Dividend stocks. I will discuss all of those trades in today's video. In addition, I have perhaps the most extensive agenda of any of my videos today. I am going to go through SBUX and how I plan to accumulate a really large position in SBUX. So I have a case study there. I want to talk about Realty Income. I'm getting a lot of questions about Realty Income from the community. I plan to buy more shares next week, most likely. I have some analysis to share there. I want to share a dividend reinvestment analysis on PPL Corporation. It's really great to reinvest dividends in a down market, in a bear market, in my opinion. I want to show a case study of that firsthand. I want to talk about McDonald's and their balance sheet. I want to talk about some financial analysis there. I've been getting a lot of questions from the community on McDonald's, and I want to go through my ride or die stocks. I'm going to talk about some criticism that 2 of my holdings have received recently from the government. The first criticism, the critique, is of ALTRIA from the Federal Trade Commission. I'll talk about that. The second criticism is of 3M, one of my favorite stocks. President Trump recently issued a tweet criticizing 3M. So I want to share my thoughts on that critique of 3M and how I see things playing out. A lot of other things to discuss in today's video. This is dividend investing all day, every day, just like the shirt says. Everyone, get ready. This is going to be a really exciting video. All right, so segment number 1, let's just talk about the trades. Which stocks did I purchase this week? I'm going to share the trades on the screen right now so all of you can see. So the first trade that I made was on Tuesday. It was of SBUX. I purchased at $67.24. And, is this a stellar deal? Is this an amazing deal right now for SBUX? At a PE of 27 for 2020, not necessarily, but the way I look at SBUX, I'm going to share this later in the video today when I show all of my ride or die stocks, is I'm not only looking at the current metrics because the current metrics are skewed. 2020 is just going to be a bad year. I'm looking more towards the future, and I'm also looking at just where it has been and how far it is off the high. SBUX is really far down. When I look at their earning potential 2-3 years out, it is tremendous. And so I think some of these metrics right now are misleading, of course, because 2020, it's not going to be a good year for SBUX. It's not going to be a good year for most companies, but I am averaging in. I want SBUX to be one of my largest positions in my portfolio, and so I just keep adding. I'll talk more about that in a minute. And speaking of SBUX, just check this out. I'll share on the screen right now. This is the particular coffee that I have been drinking at home this week. While it's not the same experience as actually visiting SBUX in person, this new formula, this concentrate of their cold brew, it is not bad. It is okay. It is pretty good coffee for an at-home consumption, and I've been enjoying it quite a bit. So just wanted to share that new product from SBUX. And in fact, I have that very SBUX here. This is going to be a longer video today, so I have to have my coffee to keep me going. And so what other stocks did I purchase this week? Check it out. I purchased more shares of McDonald's. This was just so exciting. Man, this was on Thursday. I purchased McDonald's at $157.86. Yield is over 3%. PE is not that great, 20.91. But again, this is a weird year. McDonald's is not going to perform well this year. In fact, when I look at their earnings estimates from the analysts each week, it's consistently dropping. For all of my stocks, each week, worse and worse and worse. The analysts are catching up with what's going on. They're recalculating their forecasts. They keep going down, and I think that will happen. But again, looking towards the future, looking at long-term earnings opportunities, they are huge for McDonald's. And I'll tell you, I went to In-N-Out Burger the other day, and the line was really long at the drive-thru there. And so people still need to eat. thank goodness for these companies like Starbucks and McDonald's that are equipped in many of their locations to offer drive-through and to do it in a socially distanced and safe conditions during these unprecedented times. And so it was nice. It was just nice to buy more McDonald's, my number 3 favorite stock of all time. And it's the first purchase, net new capital, other than reinvestment, that I've done in a while. And so that was my second purchase this week. The third purchase is actually Duke Energy. I forgot to share this one on Twitter. It has been so busy, and I'm trying to take a little bit of a break from Twitter, social media a bit, just to focus on other stuff. And so I didn't get this one out there, but I'm doing it now. I bought more shares of Duke. This is, again, one of my ride or die favorite dividend stocks of all time. It's a regulated electric utility. Everyone needs electricity and energy, even during these unprecedented times. And so I went ahead and I bought some at $78.05. And that's a starting yield of 4.84%. PE there in the just under 15. And so it's I'd say fair value. It's not, again, a deep discount. And so a recurring theme here is I'm buying into reasonably fair value, but I don't want to hype it up. I don't want to hype myself up. I don't want to think and fool myself. Ian, you're getting deals of a lifetime. No, but I'm getting a lot better deals than I was earlier this year or late last year. And so I'm happy to do it. I'm happy to continue to average in. But if you check this out, the average PE on a forward basis for 2020 earnings for the 3 stocks I purchased this week was actually a 20.89. So that is, if that were down at 15 or lower, I'd say probably that would be more of a bargain. That being said, the PE, it's a little misleading because 2020 estimates are just, they're not good, and they're going to get worse. And so that's what I did this week. Going forward into the next few weeks, I'm going to do the same thing. I'm making smaller purchases. I'm averaging in. I'm staying focused. The temptation is there. I've been tempted to buy some of my stocks that are not ride or die stocks, but no. I'm forcing myself here, and it's hard some days, but I'm forcing myself to stay focused on my favorite stocks of all time because it keeps me disciplined, it keeps me in quality. And here's the deal. Out of the 44 stocks that I own, no dividend cuts yet. I'm sure there will be some, but so far I've been fortunate. And I've been fortunate because my strategy has been focused on quality. And now that this whole unprecedented virus is happening, my strategy, it's getting even more focused on quality than ever before. So of my 44, now I'm just focused on the top tier of those ones. I want most of my money to be in those stocks. On a go-forward basis, that's where I'm putting my capital, because I would rather have slower returns, if you will. I would rather have be paying for more expensive prices, if you will, like I am here. But if I'm getting quality, I'm ensuring myself no dividend cuts in the future. Now, what's funny about all of this is one of my subscribers sent some data to me, and he's like, Ian, I ran some calcs on your ride or die stocks, and they've actually vastly outperformed the S&P 500 over the last how many years when he did the calculation. And so perhaps by focusing on quality, I will see even better results over the long run. We shall see. But for me, it's more of a risk mitigation measure. I know I've been fortunate so far not to face any cuts, but I think perhaps 1 or 2 or 3 may happen across the portfolio. Certainly not in my top tier stocks, I don't believe. But this has been an eye-opener. I continue to learn, and I am prioritizing quality these days. That's what I'm all about these days. And so just as a refresher, if you haven't seen my last few videos, I want to share on the screen right now as well the stocks that I bought last week and the week before. So check it out. I'm going to share that really, really quickly on the screen, and I'm also going to bring it up right now for myself. Okay, there we go. And so last week I bought some J&J, some 3M, some Starbucks, and week before Starbucks, 3M, Starbucks, Home Depot, and 3M. And so you see some recurring themes in there. The recurring themes so far have really been around Starbucks and 3M with some other amazing top tier companies thrown in as well. And that will be the theme going forward for me at this time. So share in the comments below, what stocks are you buying right now? What's on your mind? Are you focused on quality? Are you going for deep value? Hey, we're a global community of dividend investors. Everyone here has a different strategy. That's what's fun about this community. Share your strategy in the comments below. It's so cool to see what everyone is doing these days. So I want to move on now, and I want to share some thoughts on Starbucks. And so check this out. Basically, I've just been taking a step back and I've been thinking about my approach. Like I said, last week I was kind of challenging myself, Ian, should you be picking up some of your non-core stocks? Some of those stocks that you hold in the banking sector, for example, they're really not doing well. Would you be better off just breaking your rules and putting a little bit of money into some of those riskier stocks? Or should you stay focused on your top quality stocks like Starbucks? And so for me to answer these types of questions, I always find that modeling stuff on paper, whether it's doing an Excel analysis or even whether it's writing out pros and cons, that helps me. And so what I did really quickly is I did an Excel model that I want to share on the screen right now as it pertains to Starbucks. So check this out. And the purpose of this model was really to understand percentage allocation. I kind of think, Ian, a few years from now, where do you want Starbucks to be? Do you want it to be where it is now, which is basically just 2%, 2.27% of your portfolio? Or do you want it to be more? Do you want it to be 4.5 to maybe 6% of your portfolio? Clearly, I want Starbucks to be a good, say, 4.5 to 6% of the portfolio. And so I start then thinking, okay, I have a pretty established portfolio. The amount of net new capital I'm adding, it's not moving the lever as much as it used to do. It just doesn't, because the amount of money I'm putting in as compared to the overall size of the portfolio, it's kind of like steering a bigger kind of ship these days. It's not like a speedboat anymore where I can just add more money and it bumps up in allocation, but it's more like running almost like a cruise liner, like I'm kind of steering it slowly. That kind of opened my eyes, and I started thinking, Ian, if you want Starbucks to get from here to here, that's why you're focused, and that's why you can't afford at all. You can't afford any deviation from the strategy, because if you do, Starbucks will never get to the allocation it needs to be at for your goals. And so check this out. The current price per share of Starbucks, it's $63.05. It's down from the 52-week high, actually, of 99.72. It's down 37%. And again, this is what I'm saying. You just look at things on a strict valuation metric. Valuation looks like it's overpriced. Generally speaking, though, look, I believe in inefficient markets, but I also believe that they're somewhat efficient. Without this virus, Starbucks would be way higher. They'd be earning a lot more. The EPS would be a lot higher. And so I look, hey, when's the last time Starbucks was down 37%? It doesn't do that frequently. And so I start thinking, this thing is down. Yeah, the fundamentals don't look like you're getting a steal on a price, but if history repeats itself and it gets back, society gets back to where it was before, no brainer at these prices. That's how I'm looking at it. And so remember, at home, don't just look at raw PE, but sometimes it is helpful to look at the history of a stock. And sometimes with Starbucks, for example, I believe at 99, maybe it was a little overvalued, but the market had it there for a reason. It was there for a reason because of a thriving, growing business, which I believe will come back one day. And I'm willing to wait it out because I buy and hold forever. Anyways, what I started doing next is I just said, look, if I focus my efforts, I just started looking at dollars. Ian, how much money do you really have to invest in the market over the next, say, 2 months, 2.5 months? I probably can basically, in terms of raw dollars, if just assume a steady state portfolio value, I can add about 1.5% more money. And so maybe more, but if that's what I'm doing, basically what I started thinking is, okay, if you can only add 1.5%, what happens? Well, if you put it all in Starbucks, that's taking your Starbucks up to 3.77. It takes you from a 2.27 to a 3.77. Like I said, if I focus that 1.5% money somewhere else, it quickly dilutes my efforts to build up Starbucks. But then get this, I started looking at it also. Starbucks is down. It's down about 37%. I would say it's down more than a lot of my other stocks, top tier stocks like Johnson & Johnson. We'll see that more in a minute. And so I start thinking on the upside, Starbucks is probably going to have a little more volatility on the way up and as it has on the way down. And so I start thinking, right now, just say in the next 2 months, Starbucks stays kind of flat, market stays kind of flat, I can get my 2.27 up to a 3.77. That alone will be really awesome. But it gets better. In about a year or two, when the market recovers, I think this one, as compared to the rest of my stocks, everything will go up. But I think disproportionately, Starbucks will go up quicker, probably about 15% quicker. And if that is the case, my Starbucks will go from a 3.77 allocation to a 4.34, because I'm assuming everything goes up, but it doesn't all go up at the same pace. Starbucks will probably go up at a quicker pace because it has more volatility because of the fact that it's a restaurant. Restaurants are getting hit a little harder than something like a Procter & Gamble or a Johnson & Johnson, for example, that are just essentials that people need no matter what's happening with this nasty virus. And so basically, I believe if I focus my efforts in, say, next year or two, I can get Starbucks to a 4.34% allocation, and I'll be doing that at the expense of other stocks that just aren't as important. And so the purpose of this analysis at the end of the day is to show me, Ian, you have a bigger portfolio. The amount of money you're adding as compared to the overall value of your portfolio is small. In a dollar basis, it's a good amount of dollars going in, but I'm just saying it's like steering a cruise ship versus steering a speedboat. Because I've been at this a long time, I've been investing for over 20 years, the portfolio has had time to compound, the miracle of compound interest. And so I have to be real with myself that, look, if I have any hope of these ride or die stocks getting to the actual allocation I want them to be at, I can't be fooling myself anymore. I can't be going and putting money in new positions or going after the less important positions. I have to double down on what matters. And so this analysis, I already maybe I thought this instinctively, but now that I've done this analysis, I know I'm going to stay focused on ride or die. And at home, for all of you, everyone has a different strategy. It may be completely different for you. You may have a very different strategy. People just starting out with a brand new portfolio, it may be a different strategy. But for me, at least, this is the type of analysis I need to do to inform my strategy and keep me on the right path. And so that's Starbucks for you. Lot of ground to cover today. That was topic 2. I want to go into topic 3. I want to go into the miracle of dividend reinvestment. And so just as I'm saying, I'm not going to focus too much on these ancillary positions. I want to talk about an ancillary position. I want to talk about PPL Corporation. And so I want to bring that up on the screen right now. And PPL Corporation, it's a regulated electric utility. This stock has had a lot of downside. I don't fully understand why. I think some of it has to do with their UK exposure. And some folks on my Facebook group from the UK were explaining this to me. I don't remember what they actually said, but they were explaining to me why PPL is a little more volatile because of the way electricity and utilities work in the UK. Please share in the comments below, by the way, those insights again for the whole community to benefit. I do apologize. I don't remember right now what was said. But basically, there's a reason this one has a little more volatile than the rest, and it's an ancillary position. Most of my, or not most, but a good chunk of my ancillary positions, I'm not reinvesting dividends anymore. The reason I'm doing that is some of the dividends I actually use to pay bills, but some of them I'm just pulling up now and reinvesting into my Starbucks of the world, Starbucks and 3M, those core stocks. But certain companies like PPL, look, it's a newer position. I want to build it up. I don't want to add more money. I was tempted to buy more. I really was, but that's why I did my Starbucks analysis to remind myself that if Starbucks has to get from here to here, the only way I can do it, given the circumstances I have, is to focus. But basically, what I have decided with PPL is, Ian, just reinvest the dividend. At least that's something. And so that's what this analysis shows. Check this out. On April 2nd, I bought more shares of PPL at $23. And this $23 is a 30% discount from my average purchase price. My purchases so far in PPL, you can see at the bottom here, we're in January of this year, December of last year, and August of last year, and my average purchase price is $32.86. It's down 30% from there. regulated electric utility. It's not on my core ride or die list. Duke is. That's why I bought Duke. Nonetheless, this is why being dividend investor, it's so exciting, because in a down market, the dividends reinvest at progressively better prices. And so I was able to reinvest at $23. And this is a starting yield of 7.2% on that reinvested dividend. And so, yeah, I'm not adding net new capital to PPL, but something that is so exciting about being a dividend investor is even though I'm not adding net new capital, I am reinvesting dividends and I'm getting great value on that reinvestment. And so sometimes I'll tell you, people, I'm even in this situation sometimes. I wish I could add more money. Is it tempting to go after the emergency fund? Not really, honestly, because now I've gotten used to it. But in the olden days, I was always tempted to go into the emergency fund and use it to buy stocks. And at one point, I had no emergency fund. In recent years, I do have one because I'm a married man with 2 kids. I just can't afford to not have an emergency fund. But the point is, let's say I had no more money to invest in the market right now. Look, I wish it were more than I just shared on the StarBucks example. I'd say maybe over the next month or 2 months, I can increase my portfolio by about 1.5% if I just focus on Starbucks. I wish it were more. I wish it were 5% or 10%. It's not. And it's tempting sometimes, at least not now, but historically, go in the emergency fund. What I always do as a dividend investor is I try to trick myself. And so one trick that I play is if I have those temptations, I look at case studies like this. Don't need to, Ian. Don't need to dip into the emergency fund. Why? Because your dividends are reinvesting and you're reinvesting at progressively lower prices. And so that gives me comfort. Even though I'm not buying PPL here, I know the dividend's reinvesting. And even though I wish maybe I had more money to put in the market, buy all kinds of stuff, more than I am, at least I can rest assured that my dividends are reinvesting. Something else that's so exciting about being a dividend investor that I'll just interject here is my prayers go out. A lot of jobs these days, because of this nasty virus, people are already facing hardship, layoffs. Some are concerned that that might be around the corner. I pray that this all resolves quickly and that all of those jobs bounce back sooner than later, real soon. The economic devastation from this has my heart just as much as the people on the front lines, either combating this invisible enemy or the nurses, the doctors, the truck drivers, the clerks at the supermarket, as well as people affected health-wise by the virus. But my heart goes out to all of them, my heart and prayers, but also to those facing economic hardship. And so one thing that's exciting about dividend investing, it gives us all options. Look, in an economy like this, one valid strategy for a dividend investor is to say, okay, I'm not going to reinvest at all. And yeah, it is frustrating because I'm not taking advantage of lower prices, but it allows me to build up even a bigger emergency fund. And so that's an option. And what I like about dividends is it gives us options. It gives us the options, like I am, deploying some new capital and reinvesting most of my dividends. It gives options to those who are not deploying new capital, but still have the benefits of reinvesting. And it gives options to those that are like, hey, I want to be careful here and cautious. Not only am I not going to deploy new capital, but I'm going to stop reinvestment and I'm going to build up some cash. All of those options are on the plate. And what's so exciting about those options is none of those three involve selling shares. None of them. Now, certainly that is kind of a fourth option. That's an emergency option, is that option is there to sell shares. But generally speaking, that's something I would only do personally speaking, in a last resort. One of the reasons I love dividend investing so much is there is that flexibility to have those financial options without selling shares. And so that's that. PPL Corporation, reinvesting dividends, dividends all day, every day. Good stuff. I really like that. Now, I'm going to interject something here in the video. I'm going to take a break here from the dividend content. I want to go into some related content because I was just talking about first responders. And so, look, this is going to be a longer video. There's timestamps in the description so that all of you who can't see it in one sitting can come back, can reference different parts that you want to. People ask me, why don't I do shorter videos? Ian, you could have more subscribers, this and that. I don't do this for the subscribers. I do this for the culture. I do this for the people who want to be watching a 1-hour video. It's what I do. I do it for the culture. I'm trying to put my best effort, my best content forward. And so in that respect, look, I make some money here on my platform here on PPC Ian. I make it through advertising and through selling merch, and eventually I'm going to be selling a book that I'm working on. But I hope a lot of you who are familiar with YouTube and with content online recognize that in general, this isn't a channel that is trying to over monetize. I'm not selling, at this time at least, courses or private groups, this and that. Why? It's just not in the cards for me. It's not something that I feel like I want to do. But what I am going to do today is I want to ask for your help. I want to ask for your help right now. And if you are part of this community, if you value the content here, you value the effort I've been putting into this channel, this is an opportunity for you to do something amazing. My good friend Bernie, his wife is a not only good friend, one of my best friends, my homie, my brother from another mother. His wife is a nurse, and she is out there on the front lines doing heroic effort. And she's based out of Florida and works with a bunch of other nurses. They are all working really hard in the ICU that is set up for this very virus. They are responding to people who come to the hospital with this virus or with conditions. They think they have the virus. They are triaging these people. They are helping them. They oftentimes, from my understanding, are working outside in the hot Florida sun in a tent. They're working long shifts. They unfortunately don't have enough face masks and other equipment. More than that, though, they're working long hours without proper refreshments, lunches, food, moral support. And so what I've already done is I have combined forces with my friend, and I posted some links. I posted some links on Twitter, Instagram, and Facebook. And God bless all of you. Through this community so far, including my own donation, we have raised $425 through the GoFundMe for Bernie's campaign. And what my man Bernie is doing is he is going out, he is buying lunch, refreshments, waters, snacks, masks for these first responders. He's getting it directly in their hands. As I talk here, I'm going to share some photos on the screen. They are already benefiting. And I will tell you something that is very a nuanced point here. If you choose to donate, and I will pin a link below in the comment, as little as $1, not only are you helping the first responders in Florida who are doing amazing work, they are doing holy work, in my opinion, fight this invisible enemy. You are helping them. You're helping their safety, perhaps, by providing masks. You're certainly helping their morale. This morning at 6 a.m., Bernie delivered refreshments, breakfast, from our donations to these nurses, and he saw an instant improvement in morale. And so you're helping basically fight this invisible enemy. Moreover, you are helping a friend of mine, because I can tell you, Bernie is involved as well. He's not a nurse, but he is the spouse of a first responder. And that's what I want to give a shout out. Anyone who is watching, if you're a first responder, or just as important, if you are a spouse of a first responder and you are part of this solution, bless you. God bless you. Prayers to you. Mad props to what you are doing, because the spouses and the families, they are just as important as the first responders, because we're in this as a team. And so Bernie, to keep his mind, quite frankly, off of this situation, he has decided to take action, and he is working his heart out. He stood in line the other day to get some of these, I'm going to share a picture on the screen of these face plates that go in front of the face to protect the nurses. He's donating those to the hospital, and he had to stand in line for those. And he told me that people were fighting and shouting in the line. And so it's just sad to see what is happening. But rather than be part of the shouting and the fighting, why not regroup and focus on positivity? Positivity. And so, I'm actually going to share a video clip here right now. The nurses this morning, they put this together to thank our community just for the breakfast from this morning.
Thank you, Ian. Thank you, Ian.
Okay, and so I hope you enjoyed the clip. It was it made my day when I woke up and I saw that. I want to take a quick minute to thank the community members who already responded and donated. One of them was Dividends for Hope. I hope you're still watching, brother. You've been here since the early days, and I'll tell you, please comment below if you've been here since the early days when I had basically probably less than 1,000 subscribers, and Dividends for Hope was always there supporting the channel, and we were always having conversation in the comments below. There was just a core group of us having conversations about dividend stocks. Comment below if you remember Dividends for Hope. But he came through with the $100 donation, so thank you for that, brother. I really appreciate it. My man Ka came through. Nicole, thank you, Nicole. I've met Nicole at one of our meetups before. She came through. Bless you. Thank you for your donation. My man Donnie. Oh man, Donnie, thank you for your donation. Went really, really far. So bless you. Kirk, thank you, Kirk, for your kind donation. And Anonymous, we don't know who you are, but you do. Thank you for anonymously donating to the GoFundMe campaign for those nurses in Florida, helping support the effort that Bernie is spearheading. And at this time, I just want to see, I'll tell you my goal. I want to see if we can get food to these nurses every day until this thing is resolved. So anything you can contribute, pin comment below, as small as $1, whatever you can afford. Look, we're 50,000 strong. If each of us did just $1, imagine what that could accomplish for the nurses in Florida and perhaps beyond at that point, at that scale. It's amazing. And I'll tell you something been on my mind. And don't worry, I'll get back to dividend stuff, but there's, I get critiques sometime. Ian, stay on topic. Don't talk about religion here. Don't talk about this or that. I'll tell you, this is my personal journey. This is a vlog of sorts. You follow my journey, you get it all. You get the dividend stocks, you get a bit of other stuff. So I hope you all are enjoying all of it. But I'll tell you, a few things come to mind. There's two types of kind of bank accounts out there. There's the financial bank account, and that's what I talk about here a lot. I talk about dividend stocks all day, every day, just like the shirt I showed you earlier says. But there's another bank account, and it's kind of that spiritual bank account. It's the karma bank account. It's kind of the bank account of good deeds that you and I have done. I've been thinking a lot lately during this time. This is an opportunity to build up that spiritual, that karma bank account as well. So if you can contribute, and look, if you cannot contribute, even if you can pray for the effort, that would really be a huge contribution. And I'll tell you, I just want to personally emerge from all of this and look back at this and have a story to tell my kids and grandkids that, you know what, when times were rough, we stepped up to the plate and we helped others. And so thank you again, everyone, for considering sponsoring Bernie's efforts here to raise some money to do good work for these nurses. And in turn, the nurses will be able to better heal society out there and move past this nasty virus. All right, everyone. So back to dividend content. Let's talk about Realty Income. Next segment, Realty Income. So I'm getting a lot of questions. Ian, do you think Realty Income is going to cut the dividend or the distribution because it's a REIT, real estate investment trust? No, no. And if they do, it'll be minimal. I don't think it's going to be a huge cut. And I'll probably buy some more Realty Income probably next week. We'll see. I'll share it on Twitter when I make my trades. But to arrive at this, I didn't just come up with this in my head. Oh, Realty Income's good. They're not going to cut it. No, I looked at some numbers. And so I went to Realty Income's website, and I want to share that on the screen right now with all of you. I'm going to share some really cool analysis. And so here we go. Let me pull it up on my own computer. And also, let me actually take a quick sip here while you guys are waiting of my Starbucks coffee. This is going to be a long one. I'm warning you. This is the analysis I did. I looked at all of the industries that Realty Income shares on their website. And I went through them. And I'm not showing 100% of all industries here because the list is too long. But what I did, I went through them one by one by one. And I picked out the industries that I felt were at risk. And so I'm going to share that on the screen right now. And the first one is aerospace. Next one, apparel stores, childcare. You can see stuff on this list. Like, obviously, people aren't going to apparel stores now. They're probably mostly closed. And so home furnishings, oh my goodness, who's buying home furnishings right now? Well, maybe some of them if they're at like a Home Depot, for example, but I'm talking about like a furniture store, probably not as much. And you see like health and fitness, movie theaters, those are the big buckets that are at risk. Anyways, when I add up all of these at-risk industries, they add up to 24.5%. So the way I look at it is if there were a distribution cut at Realty Income, which probably I don't think there will be, but if there is, I think it's probably not going to be more than 24.5%. Probably less because some of these will do okay, some won't. The ones that are most risky are health and fitness and theaters. And so that was one way of looking at it. And it kind of gives me peace of mind. Hey, on the downside, I've got a 25% dividend cut. But the stock, by the way, you'll see this a little bit later, it's down a lot more than that. And so this is why I'm excited about Realty Income. I think the stock, I'll pull it up in a minute, but it's down like, say, almost 50%. It's down twice as much as the risk to revenue. And that's when I start seeing, hey, market's not so efficient. There's maybe directionally it's efficient, but there's a pricing error there. It's pricing mistake because it's down a lot more than the risk would suggest. And so I want to share now something else. What I did next, I look at the at-risk tenants. So Realty Income on their website, it shares their top tenants and who are they? And so I started going through them. And I'm sharing here the ones that seemed risky. And so LA Fitness, AMC Theaters, Regal Cinemas, Lifetime Fitness. Out of their top tenants, which by the way make up 53% of their total pie, I found these ones are the riskiest, and it's about 11% of the total pie. And so 11% of 53%, I would say, is at risk. And what is 11% of 53%? It's 21% if I extrapolate that to everything. And so this is just another kind of back way of looking at the industry analysis. Industry analysis showed me 24.5% of revenue might be at risk. This analysis shows me that, hey, 21% is at risk. And so somewhere between 21 and 25% of revenue could be at risk in the worst case. Now, let me remind you, Realty Income, it's a triple net lease company, and so there's not much overhead here. They outsource to their tenants everything, tenant improvements, property tax, everything. The overhead of this company is very small. In their corporate office, they don't have a lot of people even working there. And so it's not one of these things where, all of a sudden, if they lose this revenue, they can't make ends meet because they have this huge operation. No, the operations is nothing. It's a core group of people in the office, and that's the beauty of the business model. And so for me, when I look at this, it gives me some peace of mind, of the portfolio. Certainly, this is a ride or die stock for me. And of my ride or die, this one actually, of anything in ride or die, might be most at risk of a distribution cut. But if there is a distribution cut, I think it's more than priced into the share price at these levels, because the share price is way down. I think it's down like 50%. Again, I'll pull it up later in the ride or die stock discussion. But it's certainly more than the risk of rental defaults would suggest. And so that's my quick and dirty back of envelope analysis on Realty Income. And I look forward to picking up some more shares very, very soon. By the way, on Realty Income, I'm going to share this tweet on the screen right now. I did this last week. I shared Mike the Investor. This week, I want to give a shout out to my man, J Mac Investing. And so as someone who has been blessed to build up my channel 50,000+ strong, truly grateful. Please subscribe if you appreciate the effort here. That's the greatest way you can thank me. I want to start in my videos each week just sharing another channel, other channels out there in the dividend space that are really cool. And one of them is JMac Investing. And so JMac honestly gave me a scare on April Fool's Day. He put up this thing on Twitter that it basically looked like Realty Income had cut the distribution, and I actually believed him, and he got me so good. And honestly, my first reaction was, hey, it's certainly within the realm of possibility. It could happen. I'm okay with this. Potentially even buy more, but there was no cut. He was just fooling us all. So man, JMac, you got me, and I know you got a few other folks in the dividend community. So thank you for keeping the humor going during these unprecedented times. I want to get into the next section now. I want to talk about McDonald's. And with McDonald's, I bought more, but people are saying, Ian, why are you buying more? They have a horrible balance sheet. And so let's look at that. I want to bring up the balance sheet in a minute. Before I do that, though, I want to add a disclaimer. I got a comment recently, and a comment went like this: Ian, you kind of come up with conclusions before you do your analysis. And then you use the analysis to validate what you did. And honestly, in the past, people criticize me, and I just kind of brush it aside and be like, no, don't criticize me, I'm right. These days, honestly, one thing this virus has taught me is everyone, including myself, it's important to be humble. And I'm taking in different viewpoints these days. I'm just trying to take it in because I'm always learning, and I'm quite frankly, I'm okay being wrong. I probably do a lot of things wrong in life and in investing. And so that's why I always have disclaimers here on my channel, by the way. I'm just sharing my journey. There may be things I'm doing wrong. Probably am. Anyways, that got me. I just want to share that, and so I'd be curious in the comments. Share it below if you think that way, or if you think I'm doing an analysis that's inaccurate or wrong. Educate me. I want to continue to learn. That's the point of this, after all, is improving. And I was thinking about this last night. These times got me thinking a lot, and I just want to be the best investor I can. I want to learn, and so if there are mistakes in my analysis, boy, please point them out. I'd love to hear them, and I have no problems. That'd be the best thing, actually, if I could learn. If I'm not learning, life is too boring. And so, anyways, I want to share McDonald's. Let's just start with the balance sheet. Let's start with it. And so I'm putting that up on the screen right now, and you'll see this really quickly. The total assets of the company are $47 billion, and that's one of the things I love, by the way, of McDonald's. This is, I believe, I pulled this from their quarterly report for the Q4 of 2019. They don't have their 2019 annual report out. I couldn't find it, so I pulled it from the quarterly, and I love it. They've got a lot of assets, and the reason they got a lot of assets is this is a real estate company. They own a lot of real estate, and that's what I love about this company. They don't even operate a lot of the restaurants anymore. A lot of people ask me, Ian, their revenue's down. Why do you invest in them? The reason the revenue's down over the last several years, or if you look at like last 5-7 years, is they've been refranchising. They've been actually finding that the stores they operate, they're less successful than their franchisees. And so what they've been doing is they've actually been working with franchisees to, they continue to own the real estate, but they partner with an operator, and that operator operates the restaurant and leases the real estate from McDonald's. And so that affects the revenue coming in on their income statement. Revenue goes down, but margins, earnings go up, because the revenue now from sales from those products, it's realized at the franchise level, not at the McDonald's level. But what McDonald's is realizing is the rental payments they get from their franchisees. And so just something to be aware of with McDonald's. It's a nuance where a lot of people miss that, and they think McDonald's is failing, but they're not. They're actually doing really, really well, in my humble opinion. And so anyways, I love the fact that they got those assets. They own the real estate. It's a real estate play. My number 3 favorite stock. It's not only a restaurant, but it's a real estate company. And you'll see the liabilities, they're up there. They got mostly under long-term debt and long-term lease liability, because I imagine that's related to lease obligations. They don't own all their real estate, I guess. But you add all that up, and it's a lot. And in fact, it's more than the assets, because if you look at the bottom, if you look up the shareholders' equity, it's a deficit. The shareholders' equity, assets minus liabilities, is a negative $8 billion. And so this is what totally gets people with McDonald's. They don't like it. And I started digging in. Why is it negative? What's going on? And the best I could decipher is these guys have been on a buying rampage of their own shares. They've been buying back their own shares over the last, say, decade. Certainly since 2014. I read a report that analyzed 2014 versus current day. They've been buying back a lot of shares. Personally, I have mixed opinions on share buybacks. Honestly, I don't really like them. But I'll tell you, no company is perfect. Any company in my portfolio, there's going to be things I like, things I don't like. Hey, I'm a passive investor. I can't tell McDonald's what to do. Maybe one day, if I'm a real thug life investor, I'll own enough shares to get a seat on the board and tell them what to do. But that's pretty unlikely. Although, man, that would be cool. Starbucks. One day, please have me on the board. That would be my dream. But anyways, I digress. That's what's got people worried. And quite frankly, they're right. I'm not going to dispute it. I'm trying to harness that feedback I got that, Ian, don't use your analysis to just make yourself feel good. And it's true. I look at the numbers here. I wish they had a little less debt. And I wish they had less debt because I don't think they need the debt to buy back shares. Now, on the flip side, though, it's a low interest rate environment right now. We're going to look a little bit more at that in a minute. But that's why. And so... and they're taking advantage of low rates. And look, the low rates, they're here to stay. With the amount of debt that is happening at a government level even now, the interest rates, they're just not, it's not going up, I don't think. If it did, it'd be catastrophic. The economy couldn't handle it. It would be a reset at that point, quite frankly. And so I don't fault McDonald's too much for it, but yeah, I wish they wouldn't take on more debt. It's a negative of the company. So let's bring this up, though. Let's bring up the income statement next. And so I'm going to show you the income statement now that we've looked at the balance sheet. And you'll see something here. What are we seeing? Revenues, they're up 2019 versus 2018. And we're seeing operating income is up. Nice clip, quite a bit, from almost 2 billion to 2.29 billion. One thing... Now, keep in mind, this is the fourth quarter number. And so I'm looking at the fourth quarter. Balance sheet shows all the balances because it's a balance sheet is a snapshot of the books. So it shows the books. But what you're looking here at the Q4 income statement is not all of 2019. You're looking at Q4 of 19. And so versus Q4 of 18. So if you will, you may need to multiply these numbers by 4 to kind of get to something annually here. But needless to say, it's nice to see the trends are in the right direction. And you see something here that I like to look at. Interest expense. The interest expense is up because they're taking on more debt. And the interest expense is $283 million. Now, let's just run a quick back of envelope analysis here. And so what I'm going to do is I'm going to go into my Excel and I'm going to do this $283 million. What is that if I multiply by 4? It's $1.1 billion. Okay, so I'm going to go back to the balance sheet and I want to look, how much debt do they have? They got $34 billion long-term debt. So let me just put that in here. $34 billion. If I take the $1.1 billion and I divide by the $34 billion, interest is coming in around 3.3%. And so once again, let's just look at this interest payment. Let's just look at it again. I'm going back to the income statement again. On the income statement, this interest payment is a very small percentage of their business. It's $283 million versus operating income of $2.3 billion. And so I'll tell you something. The way debt works in corporate America, it's a little different than your traditional mortgage. Traditional mortgage, typically you've got some debt. And the debt, for a lot of people, it's a fixed rate mortgage, meaning each month you pay down interest and principal. But I'll tell you, the way it works with companies like McDonald's oftentimes is the most important thing to look at is the interest. Why? When they take out debt, they're not really going to repay the debt because they believe the interest rates are going to be low for pretty much ever. And so what happens is their interest payments they're going to keep happening. No doubt. You got interest payments. But what happens is, say, every 10 years, because the debt often is at 10-year terms, they just refinance into another loan. And they refinance. Typically, they're not paying down the balance. And I'm not saying this isn't, this surely is not a good thing. I wish McDonald's had no debt. I'm saying it's a con with the company. That being said, I'm just trying to say, for me, when I analyze debt, what I want to analyze, because I believe interest payments or interest rates will continue to be low, what I want to analyze is what's the debt payment? What's the interest payment? What is it? And I see what it is here. It's 3.3%. It's a reasonable rate. And I see here that it is $283 million on a quarterly basis for a company that is driving a lot more than that in terms of revenue, operating income, net income. And so that gives me comfort, at least, with their ability to pay their interest payment. Is it good that they have the interest payment? Not necessarily, but it puts things in perspective. And so, again, that's how I look at it. So before I conclude this segment, I want to show the cash flows as well. Let's take a quick look at cash flows. And so I'm going to share the statement of cash flows right now. And okay, this one's for the full year. So you saw on the last screen, it was for the quarter. The quarter ended. This is for the year. And so that's why this isn't jiving up with the income statement. But you see from cash provided from operations, it's $8 billion. Again, interest payments per year for this company is about $1.1 billion. And so you can see how they are able to cover interest payments. Especially if we believe interest rates are low, and they're going to continue to be low. Okay. Cash used for investing activities, you could see it's a negative $3 billion here. They're doing a lot of CapEx in particular. They're spending money refurbishing restaurants, refurbishing their establishments. And so that's real. That's real. And this is important. This is why I look at cash flows, because typically CapEx is not something that's included in GAAP financial measures, which is what is you see on the income statement or an EPS, earnings per share. That's why cash flow statement is important to look at as well. You can see here some other stuff. There it is, treasury stock purchases. They're buying a lot of stock back. 5 billion almost, 2 years, 18 over 5 billion, 19 under 5 billion. They're buying a lot of stock back. I wish they weren't doing that, quite frankly, but it's part of the beast. It's what they're doing. Dividends, 3.5 billion going out. Okay, and so the bottom line here is you've got about 5 billion worth of financing activities. You've got about 3 billion of investing activities, and you've got about 8 billion of cash provided by operations. And so they are making ends meet. And they've got a lot of leeway because of the magnitude of these buybacks. And so the way I look at it, if the business softens at all, they're going to be able to make it work on a cash flow basis. Dividend is safe, in my humble opinion. Are the buybacks the right thing? There is an academic case that could be made for it, although certainly I don't like them that much. Okay, that's McDonald's. Share what you think in the comments below about their negative shareholders' equity. I'm okay with it. But again, maybe I'm just using the data to validate how I feel in my heart, because there is an emotional side to it. I grew up as a kid always cherishing those times when I went to McDonald's. And I'll tell you, my wife has a philosophy that I thought was really interesting. I haven't had McDonald's for a while. When we do have McDonald's these days, it's more for the breakfast. We really like their pancakes, their hotcakes, and their those little tater tots. Man, are those good. It's it's not like a bunch of tater tots. It's like a stick you get in that little paper wrap, and it's like, man, that tater tot thing it's off the chain. Love it. Anyways, we get that sometimes. But lately, I've been at home, cooped up at home. Don't like it. Getting through it, but can't complain. I'm blessed, thankful for all I've got. Certainly can't complain. It would be foolish to complain in face of what's happening out there. But I'll tell you, I've really had just kind of a craving for McDonald's. And my wife's philosophy is, Ian, it's because you're cooped up at home. And what was it like when you were a kid? When you're a kid, you kind of stay home a lot. And when you're a kid, when you got McDonald's, you got to go to McDonald's. It was always really exciting. And so it's kind of like now you're cooped up at home again. It's kind of like you're a kid. And so you're kind of remembering that and it's triggering you to want it. And so anyways, I'll probably be going through that McDonald's drive-through next week. We'll do that. We'll do that. We'll support McDonald's. I just thought that was interesting what she said because I think she's right. And I think the other side of it is just cooped up at home. You kind of want what you can't have kind of thing. And so I've had a craving for McDonald's and for those fries that's so salty and delicious, especially after a long run. That salt, it's good for you, in my humble opinion. After running, I just ran 7 miles the other day, twice last week, 2 7-mile runs, and I love my salt intake after something like that. All right, but I digress. Let's bring it up. I've been talking about it. Let's talk about ride or die. What's going on with those stocks? So check it out on the screen right now. I'm going to clear my screen now of my McDonald's stuff. And I'm going to bring that up for you all, the ride or die stocks. And I'm going to get a sip of my Starbucks coffee here. Oh, that's good. All right. So what do I want to share this week? I've been sharing this every week. I don't want to go into it too much. What I want to share is the last column. I have a new column or 2 new columns, the 52-week high and how much it's down. What you see here is the companies that are down the most from the high are McDonald's, Duke, Coca-Cola, 3M. Woo, 3M, you're down, man. We'll talk about that in a minute. Will I ever be averaging up? We'll see. Starbucks and Home Depot, believe it or not, still. Realty Income. There it is. Man, 50% down. I'm buying you, Realty Income. Even if your dividend is or distribution is cut a little bit. Stock price is down, way overcompensating. Although it did get a bit ahead of itself. The reason I'm sharing this is I also have PE information here, but the PEs, they're misleading because 2020, this year, it's not a good year, everyone. It's not a good year. We know that. First, Kobe Bryant. Whew. And then this? What the heck? 2020, not a good year. We will get through it. But what I'm looking at these days is some of the stocks, they're just down, and you don't see in the PE ratio the extent of it. You kind of see it in the 3M PE ratio because that PE is down. But in the McDonald's PE ratio at 21, that doesn't reflect, it doesn't make you think that it would be down 27.8%. At the Starbucks PE ratio of 25, it doesn't make you think that it would be down 36.8%. And so certainly the fundamentals always drive my investing. But these days with my core stocks, I'm also looking at how much they're down because it's just another data point, tells me something that means something. By the way, something that means something. Far Side, one of my favorite hip hop groups of all time. Someone was saying, Ian, why do you talk about thug life investing so much here? A few things on this topic. One, something that means something. I was thinking about this song earlier today because with what I'm doing with Bernie, getting food to these nurses, that's something that means something. That's the Karma bank account. Excited about that. Want to do something that means something during these times. Hopefully what I'm doing here on YouTube is something that means something. It's like I said, maybe I could do 10-minute videos, get more subscribers. Don't care. I'm doing it for all of you that are still watching right now, all the way into it. That's what I'm doing. But what the reason I talk about hip hop a lot here is some people may think this has nothing to do with investing. Oh, yes, it does. There is so much knowledge in hip hop. It's where I've learned a lot of what I know. You may think I'm crazy. Ian, what are you saying? I'm just telling you like it is. The knowledge comes from hip hop. It comes from the streets. As I'll tell you, the amount of hustle that's involved for a lot of these artists to be successful, it's unparalleled. And And the business sense that they have developed, it's unparalleled. The knowledge that they've seen through what they have lived and through what they share in the music, it's unparalleled. I'll share with you something else, something that just really bothers me these days. It's a trick. It's a trick. It's kind of like fear. Fear is a liar. I learned that from my homie, my friend, recently. Something else I learned, or I've learned along the years, is, and this was through hip hop, just this idea of people getting down on someone because of the color of their skin or their nationality. It's a lie. It's an absolute lie. It's a trick, and it's a trick to fool all of us. And something that's been happening recently is people of certain descent are being targeted. They're being looked down upon. There's been an increase in horrible racism, and it's a trick. It's a lie. And so something I've learned from hip hop culture is there's this notion of no color lines. There's this notion of kind of increase the peace. And I'll tell you, there's a clothing line called Cross Colors, and I have a Cross Colors shirt that I purchased, and I support this brand because it's basically clothing without prejudice, and it comes from hip hop culture, and this is something I've learned through hip hop. And look, there's certain tracks in hip hop that talk about certain things that maybe are very real and maybe not, under, I guess, parental advisory, if you will. But, there's also a lot of knowledge. And so I just want to put that tidbit in here today that's been on my mind is, hey, everyone, don't fall prey to these traps and these tricks that are out there of succumbing to fear or to racism or something like that, because it's just tricks. It's all a lie. And we are too good. We are all too smart to fall victim to that stuff. And so I just had to put that tidbit in there. Anyways, what is next? On that note, let's just keep going because there's more to talk about. I'm going to get to what everyone's been waiting for. I want to talk about 3M and I want to talk about ALTRIA. So ALTRIA, I'll just start with that one. What has been frustrating to me is my portfolio's down a bunch. We're sheltering in place at home. It's kind of tough because we're cooped up. And at one point, I had a lot of hope that we could all go to church on Easter Sunday. But now at least locally in the Bay Area, shelter in place has been extended to May 3rd. And the rules of shelter in place, they're more strict than they were before. And so these mixed messages sometimes, it's frustrating. Like I said, though, I'm not going to complain. I got it good. I'm blessed. And I want to do something that means something for all the first responders out there who are doing amazing, amazing things. But nonetheless, there's frustrations, and I've got some. Another frustration is at the time when the government's telling us to shelter in place, they seem like they attacking some of my companies sometimes. And so what's happening is the Federal Trade Commission's coming after Altria, saying that their acquisition of Juul, their stake in it, was done in incorrect ways. They're saying that in an antitrust matter, there was something going down there. And so the way I look at it is there are very few companies in the world that can make a $12 billion mistake and still get out okay. Altria is one of them. And so I'm not reinvesting shares anymore. I'm not buying more, but I'm holding strong on my sin stocks. And sometimes I think, are those the real sin stocks? Just for me, in terms of where I'm at, I've talked about this before. I totally respect anyone buying them or adding to them. I own them. I'm a Thug Life investor. Boy, it was interesting to see one of my sin stocks, BTI, actually is working on the cure. They announced the other day the stock was up. They're working on the cure for the virus. Bless them. Are they? They're no longer a sin stock at all if they come up with the cure. I love that. I love that. It just flips things around. It just flips it all around. That's why these days you can't stay too convinced in any one statement. I mean, you can't make black or white statements anymore because everything is shades of gray. But anyways, Federal Trade Commission's going after them. Look, they've already pretty much written off this Juul thing. It was a huge mistake. And they will get through it. I'm thinking at this point, even if FTC invalidates the whole thing and they have to walk away from it, they'll get through it. So I'm not very worried. It is unfortunate. Does the CEO and the executive team have culpability here for wasting $12 billion? Yeah, they do. Now, could they have foreseen what would happen? No. But at the end of the day, when you're a leader at a company and something goes down like this, you're gonna have to pay the consequences. And so my heart goes out to the leadership, and I hope they get the company through it. But it probably is time maybe for some change-ups in leadership, given the gravity of this mistake. That said, I'm holding strong. Do I think the downside's already priced in? Yeah, I think people have already written off this thing pretty much. We'll see though. Maybe they'll make lemonade out of lemons, as a lot of companies are these days, perhaps. But I guess people were asking me, Ian, how severe is this? I'm just sharing my personal journey, my personal thoughts on the topic. Could be very wrong, but I don't think it's very severe. I think they'll either get completely prove the FTC wrong, or even if they lose Juul at this point, they've already written the whole thing off anyways. It's already been a $12 billion mistake. It's already priced in. 3M. So what went down with 3M that I want to share? Oh man, this has been controversial on my Facebook group, on Twitter. So President Trump, he came out with a statement the other day that he's been unhappy with 3M, and he's going to invoke the Defense Protection Act against them because basically what is being alleged of them is that their masks and ventilators were not going to America where they're needed right now. And being a company that is an American company, shouldn't they be patriotic in the sense that their best effort goes to our country? And so what Trump and the administration or President Trump and the administration are trying to do is to put a little pressure on them and work with them to make sure that they're serving both the United States and the global humanitarian efforts that they're responsible for as well, because this is a global company. In certain countries, they've acknowledged, like in Latin America and in Canada, are really reliant on 3M for their ventilator supplies. And if they don't get it from 3M, they're kind of out there without any options for ventilators. And that would be tragic because this is a global community of dividend investors, and that's my favorite thing about this channel. I think I must just be popular in Germany. Shout out to my German brothers and sisters. I love you all, but I always get a comment. Ian, shout out from Germany. We love you. I love you too. And anyways, I kind of think with 3M, look, yeah, they're an American company. They got to serve America first. But they do have humanitarian responsibilities in countries like Canada and in the various countries in Latin America as well. But anyways, I'll tell you, a lot of people, when President Trump said that, had a knee-jerk reaction, and they said, oh, 3M is bad. I'm never going to buy it again. They're awful, this and that. Oh, President Trump hates them. Let me tell you something. I've been around the block. I've been in business before. And one thing that I really respect about President Trump is he's a strong leader. And I think it's good to have a strong leader during these kind of times. And I'm telling you, I'm not going to go into my political beliefs here. I'm just trying to talk about the man as a leader. And I think he's strong. And I've worked at a lot of businesses over the years that have strong leaders. I need some coffee, by the way. All right. But here's what he's trying to do, everyone. He doesn't hate 3M. He is trying to just give them a kick in the butt. That's all he's doing. He's a strong leader, and he thinks they can do better. He's not saying it's a horrible company. He's not saying everything they did is wrong. He's not saying boycott 3M. What he is saying is 3M, you need to do a little better. You need a kick in the butt to do a little better. And honestly, I call that tough love. I've gotten tough love before. And sometimes when you get tough love, you don't like it because it's like what your best friend and he's telling you something, Ian, you got to change, maybe do this a little different. And you're like, you know what? You're wrong. You kind of think that in the moment. You may even push back, but then you start thinking and it forces you to be better. And so quite frankly, I'm happy President Trump said this because I hope 3M gets a little tough love, and they do even better. On the flip side, I've watched the statements from 3M, and I personally don't believe they were doing too much wrong, if anything. 3M, it's a global company. They do have global responsibilities. 3M has been ramping up supply. 3M has been actually, in the earlier parts of this year, doing a lot globally because other countries had problems before the U.S. And now that there are big problems in the U.S. with this virus, they're shifting efforts back. They're working with the administration. And so I'm not so sure 3M was even doing too much wrong. If they were doing anything wrong, the most that I could decipher is they have this business model with a middleman. And so 3M, basically what happens is they make the masks go to the distributor distributes them. And so allegedly what may be happening out there is some of the distributors have done the wrong thing. They've done things immoral, like getting those masks to parties that maybe not in as much need as certain locales within the United States. And that's flat out wrong if that's what's happening. And 3M has acknowledged that. 3M has put together a task force, and they are policing their distributors like none other. And so the take that I have on all of this is I don't think that what President Trump said is wrong. I think he's giving some tough love to a great company. I think they will be better of it. I don't necessarily think what 3M was doing is wrong. I think anyone, myself included, any company, there's always an opportunity to improve out there. And so they're going to use this opportunity to get even better, to improve even more. Based on the comments from their company so far, they've been very open to this feedback, and they're going to work with the administration to get business done. And so, investors out there, I think they got spooked by this. Stock wasn't down much. Maybe it will be more on Monday. But I'm going to be buying more because I support 3M. And I'm fine with them getting criticized, just as I'm fine these days with anyone criticizing me, as long as they take as long as the criticism is in a constructive way and it's taken constructively. And so I'll tell you, like a lot of people are saying, like, this is the end of 3M. I kind of look at this back when Procter & Gamble had that whole Gillette thing. Like, people here on the channel were commenting, I'll never buy a razor again from Gillette, this and that. I just been buying Procter & Gamble all along, and stock's done really, really well. And so I think it's the same kind of thing. I see like this whole PR nightmare that's happening now for 3M, kind of like what happened with Procter & Gamble. They'll get through it. It's certainly not a fundamental change for the company. I kind of look at it as just another day in business. They'll get through this. They'll be better for it. The world will be better for it. Our country will be better for it. Everyone will be just fine. At least that's my very, very humble personal opinion. All right, everyone. Really appreciate all of your support, likes, subscriptions, comments. Keep them coming. Thank you for all of those that are supporting the nurses in Florida as well, whether it's via financial contribution or your prayers and your well wishes. Really means a lot. Before I leave today, as I always do, in terms of a disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. I am just sharing my personal journey here on YouTube for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed investment advisor first. Just my personal journey for fun. In terms of full disclosure, let's do this. I own the stocks mentioned today. I am long BTI, ticker symbol BTI, Altria, ticker symbol MO. I am long Johnson & Johnson, ticker symbol JNJ, PepsiCo, ticker symbol PEP, McDonald's, I'm loving it, ticker symbol MCD, Clorox, ticker symbol CLX, Duke Energy, ticker symbol DUK, Procter & Gamble, ticker symbol PG, Coca-Cola, ticker symbol KO, 3M, ticker symbol MMM, Kimberly-Clark, ticker symbol KMB, Starbucks, ticker symbol SBUX, Home Depot, ticker symbol HD, AbbVie, ticker symbol ABBV, and Realty Income, ticker symbol, I didn't talk about AbbVie, but anyways, I'm long AbbVie as well, so it's all good. Thank you, everyone. Thank you for hanging in there. This video is for all of you who made it this far. Appreciate it. Comment below if you're one of the ones that made it this far. Comment below if you've been here since the Dividends for Hope days. If you have been, really, really appreciate it. All right, everyone. See you in the next video.